So you don't go through life, one with two portfolios, one that you're going to put in when there's a crash and one you're going to put in when there's a strong economy. That doesn't work. What you do is build your overall portfolio thinking we're going to have some problems once in a while. This portfolio overall adjusts for that somewhat. And when we have a problem, we weather the storm. And that's what we did in 2008. It went down 38%, and it's gone up 3 times, 300% since then. So the thing you got to learn is you don't sell out after minus 38%. You wait for the 300%.
When it comes to actually predicting what crisis will happen next, no one knows. No one knows. But I can give some guidance there. We can think about inflation, deflation, growth, recession, and depression as being examples. We can also think of war. So in each of those scenarios, how would your portfolio perform? 5 years before the financial crisis, also known as the credit crisis, I wrote a paper for a different purpose. And the purpose of the paper was to identify for our clients the fact that in their bond portfolio, they had an overweight to high yield, an overweight to lower quality credit that was unintended and was unrewarded. So mathematics was involved in understanding this and what the factor exposures were, but it was a fairly common problem to have with large bond portfolios. Obviously, I advise that credit exposure be adjusted to the desired level to improve the return relative to kind of the amount of risk that was taken and to remove the unwarranted risk. Investors that did not follow that advice wound up in a position where they were severely damaged in the credit crisis with their bond portfolio. And that's just the period of time when you want your bond portfolio to perform for you, to lift the rest of the portfolio. But instead, the bond portfolio performed even worse than expected because of this overweight to high yield to lower quality credit. So in this example, you can see how important it is when you say, well, I have stocks and bonds, I think I'm diversified. It looks like that on the surface, but if you can apply the kind of tools that we have, you can look in more depth and detail into the bond portfolio and understand if you have an over or under exposure to high yield credit. If you have an over or under exposure to duration or interest rate sensitivities. These are fairly technical topics, but I think that we can explain how it would impact your portfolio. We can explain why it's important to manage those risks in your portfolio should we have another crisis. May not be the same crisis that we experienced, but there you can see was an example where we were preparing the portfolio for more efficiency to take rewarded exposures, and it would have helped some clients who did not follow that advice. It would have helped them out if they had followed that advice. Some people think they're diversified if they have a stock portfolio of 30 stocks or so. They're not. There are 5,000 stocks out there. And if you have a portfolio of 30 stocks, you're unlikely to have a portfolio that is in any way efficient. In other words, you have a portfolio that has more risk than you need for the kind of return you're going to get based on that exposure. So that's one issue. There's a much larger universe, and there with the 5,000, roughly speaking, I'm speaking about highly investable, liquid, domestic U.S. securities. We haven't gotten to other developed markets and other emerging market equities that can also expand your portfolio. With bonds is more complex. There's even there are thousands of types of bonds. They're more unique, less liquid, more idiosyncratic in a way. So it's harder to sort out. So you really need some advice on what are the categories of bonds that I should invest in. So in the bond portfolio, you have to know some part of your portfolio of bonds is going to be there primarily for their tax advantages. Some are going to be there in order to protect you against a potential rise in interest rates. Well, the good news is it doesn't take investing in thousands and thousands of individual bonds to do that. There are more efficient ways that we can use and tools we have to construct a more efficient portfolio. I've worked with some of the largest institutions in the world, the most sophisticated investors in the world, and providing them advice on how to improve their portfolios. An interesting question is, how does that apply to the individual investor? But I can tell you that any investment, any pool of money is there for a purpose. So even when we look at the largest, most sophisticated investors, behind that are people who have a liability, and the liability has to be met, or the future expense has to be met. We can learn from the advantages we have in the tools and models we have. We can learn from a better understanding of the science of that and how that applies. And we can learn even more from the mistakes that these large institutional investors have made. I don't expect that every client to have the same passion or interest I have in finance and mathematics and investments and problem solving. But hopefully I can show the passion I have for it, and that might be interesting to them. That might be an incentive for them to spend more time, to learn more about it. Because after all, the stakes are very high. We can see what's happened, what's happening in the world now, what's happened with investments in the past, the kind of mistakes that have been made. It's critically important that our clients focus on outcomes, and they focus on portfolios that are efficient and will perform well in good times and bad.